Japan's bond market is under pressure most investors haven't seen in decades. The yen has been sliding. Yields on government debt have climbed in ways that would have been unthinkable a few years ago. And yet, in the middle of that stress, one investor has quietly built a position worth billions. Not despite the turmoil. Alongside it, Warren Buffett didn't stumble into Japan. Berkshire Hathaway began building stakes in 5 major Japanese trading houses back in 2020, years before anyone was talking about a currency crisis or a bond market panic. So here's the question worth sitting with. Did Buffett get rich because Japan is falling apart? Or did he understand something about that market? Long before the headlines caught up, the truth isn't as simple as either side wants it to be. It says more about your money than expected. So let's actually unpack this, because the real story is more useful than the headline. Over the next few minutes, we're going to answer 3 simple questions. What exactly did Buffett buy in Japan? How did Berkshire finance it in a way that changed the entire risk picture? And what does Japan's stress mean for you, even if you never touch a foreign stock in your life? Because, make no mistake, this isn't really a story about one clever stock pick. It's a story about debt, currency, and where the world's biggest pools of money quietly move when nobody's watching. Japan is one of the largest economies on Earth, and what happens to its bonds and its currency can ripple outward toward your mortgage, your savings, and your retirement. If you want breakdowns that respect your intelligence instead of just scaring you, consider subscribing. And drop a comment. Does Japan's trouble worry you or feel distant? Let's start with why this bet looked so unlikely. To understand why this bet raised eyebrows, you have to understand Japan's reputation. For most of the last 30 years, Japan carried a label that scared away serious money, the graveyard for investors. After its massive asset bubble burst in the early 1990s, the country slid into a long stretch of slow growth and stubborn deflation. The Bank of Japan kept rates exceptionally low for years, far below what other major economies were doing. Prices weren't rising, wages stayed stuck. For a lot of foreign investors, Japan just felt like a market where nothing ever really moved. But here's the part the headline version leaves out. Stagnant is not the same as dead. Beneath that sleepy reputation, some Japanese companies were quietly generating real cash and trading at prices that didn't reflect their worth. That gap between reputation and reality is exactly where value investors live. Enter the Sogo Shosha, Japan's great trading houses. Berkshire disclosed stakes in 5 of them: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. These aren't narrow single-product companies. They're sprawling conglomerates with their fingers in commodities, energy, metals, food, and global trade. If that structure sounds familiar, it should. It's not so different from how Berkshire itself is built. That's the piece that likely appealed to Buffett. While most of Wall Street looked at Japan and saw a market frozen in time, he and his team could look at these specific companies and see something the crowd was ignoring. Durable businesses, steady dividends, and stock prices that looked cheap relative to the assets and cash flows underneath them. So the story isn't that Buffett bet on a comeback nobody expected. It's that he bought quality that everyone else had stopped paying attention to. Which brings us to a much more urgent question. If Japan sat quiet for decades, what changed recently that suddenly put it back on the front page? So if Japan sat quiet for so long, what finally shook it awake? The short answer is that the machine keeping everything calm started to change gears. For years, the Bank of Japan ran one of the most aggressive easing programs in the world, pushing rates into negative territory and working hard to hold long-term borrowing costs down. That policy was the foundation everything else rested on. And more recently, the central bank began stepping away from the most extreme parts of that approach. That shift matters more than it might sound. When a country famous for suppressing interest rates starts letting them rise, markets pay attention fast. Yields on Japanese government bonds have climbed to levels the country hadn't seen in a very long time. At the same time, the yen has been under real pressure, weakening against the dollar. Add in renewed concern about inflation, wages, and how a heavily indebted government funds itself. And you get a market that suddenly feels a lot less predictable than it did for decades. Here's where I want to slow down, because this is exactly the point where headlines and reality split apart. When traders see yields spiking in a place that spent 30 years holding them down, they don't just see a number moving, they see the possibility that an entire system is changing beneath their feet. That's what analysts mean when they talk about regime change risk. It's not that Japan collapsed overnight. It's that the rules everyone got comfortable with may be shifting. And that's the honest distinction the loud version of this story skips. What's actually happening is stress, not a proven collapse. Serious stress, the kind that makes global investors nervous, but stress inside a functioning economy. The reason the rest of the world cares is simple. Japan is a massive holder of global assets and a huge player in international finance. If money that once sat comfortably in low-yielding Japanese bonds starts looking for higher returns elsewhere, that can nudge borrowing costs far beyond Tokyo. which sets up the real puzzle at the heart of this story. If this pressure is bad news for most, why would it work in Buffett's favor? The answer comes down to how the trade was built. This is the part almost nobody explains properly. So let's walk through it in plain English. Most people assume Buffett simply took American dollars, sent them overseas, and bought Japanese stocks. He didn't. Instead, Berkshire borrowed money in yen itself, issuing yen-denominated bonds over multiple years at very low interest rates. Then it used that borrowed yen to buy stakes in the 5 trading houses. That single decision changed everything about the risk. When a regular investor buys foreign stocks with dollars, they're making 2 bets, that the stock goes up and that the foreign currency holds its value. If the yen weakens, that investor can watch their stock rise in Japan and still lose money once it's converted back into dollars. Buffett sidestepped a big chunk of that. Because he borrowed in yen and bought yen-based assets, both sides of the trade move in the same currency. Think of it like this. If you're buying a house in another country, you don't want to borrow in your home currency and gamble on exchange rates. You'd rather borrow in the same currency as the house, so both the loan and the asset rise and fall together. That's the logic here. It's a structure that softens the currency blow that hurts ordinary foreign investors. Picture 2 people who each buy the same Japanese stock. One borrowed in dollars, the other borrowed in yen. If the yen weakens sharply, the dollar borrower takes a hit on the currency conversion. The yen borrower barely feels it because the debt they owe got cheaper in dollar terms at the same time. Same stock, very different outcome. Now the second piece, most people miss. There's a difference between owning Japanese government bonds and owning these trading houses. Government bonds are a direct bet on Japan's finances. But the trading houses earn money globally, across commodities, energy, and industry all over the world, and they pay steady dividends. So Buffett wasn't purely betting on Japan's economy. He was collecting dividends from globally diversified businesses while borrowing at rock-bottom rates. The strongest parts of this trade are clear: cheap financing, real dividend income, and durable companies. But let's be honest about the assumptions too. It still depends on where the yen heads, where rates go, and global commodity demand. Nothing here is risk-free. Still, once you see the structure, the mystery starts to dissolve. This wasn't luck, it was engineering. Which leads to the obvious next question. Just how big did this actually get? And what do the real numbers say? So if this was engineering rather than luck, the numbers should show it. And they do, though they tell a more layered story. Start with Berkshire's side. The stake it built in the 5 trading houses cost billions to assemble. Its market value has since grown dramatically, turning into one of the company's most successful international investments. On top of that appreciation, those holdings throw off substantial dividend income year after year. That's the part worth pausing on. Buffett isn't just sitting on paper gains. He's collecting real cash from these businesses regardless of what the stock price does on any given day. Before you rely on a specific dollar figure, check Berkshire's latest annual report, because these numbers move with the market. Now flip to Japan's side, because that's where the concern lives. Japan carries one of the highest levels of government debt relative to the size of its economy among major developed nations. Layer on top of it the recent climb in long-term government bond yields and ongoing weakness in the yen. But here's where you need to separate 2 different things: the size of a problem versus the speed of it. Japan's debt is a huge stock, an enormous pile built up over decades. That's very different from the pace of change. A large debt load that stays stable is manageable. A moderate one that spirals fast is dangerous. And there's real evidence that cuts against the doomsday reading. A very large share of Japan's debt has been held domestically, by its own citizens, rather than by foreign creditors who could flee. The central bank also retains significant tools to influence conditions if things get disorderly. And the trading houses Buffett owns keep generating solid cash from operations spread across the globe. These businesses remain largely insulated from Japan's domestic bond drama. Put it together, and you get a more honest picture. Berkshire's gains are real and substantial. Japan's stress is serious enough to matter to the entire world. But serious stress is not the same as systemic collapse, and the two keep getting blurred together. If rate normalization continues, these numbers could shift again in either direction. So the data gives us scale and it gives us nuance. What it hasn't done yet is answer the question that actually keeps you up at night. What does any of this mean for your money, right here at home? Here's the honest answer, and it's more nuanced than the fear-based version. You almost certainly don't own Japanese trading houses. You're not borrowing in yen. So on the surface, this looks like someone else's problem, happening on the other side of the world. But that's not quite how global money works. What you're actually exposed to isn't Japan directly. It's the global price of money, and Japan is one of the biggest players in that system. For years, its investors and institutions parked enormous sums in low-yielding assets and sent capital searching for returns around the world. If Japan's rate environment keeps shifting, some of that money may start behaving differently, staying home to capture higher yields instead of flowing abroad. When a source that large changes its habits, global bond markets can reprice risk, even if only at the margin. Why does that matter to you? Because the interest rate on a 30-year mortgage doesn't come from thin air. It's tied to longer-dated bond yields and the broader mood of the bond market. When global borrowing costs drift upward, the pressure can eventually show up in mortgage rates, refinancing costs, and even the return your retirement account earns. Let's separate the fast effects from the slow ones. The quick stuff tends to show up in market sentiment, currency swings, and the pricing of long-term assets, the kind of moves that can rattle a portfolio in a matter of weeks. The slower effects are the ones that reshape funding costs, trade, and how big investors position over months and years. Those are quieter, but they often matter more for your long-term stability. And not everyone is equally exposed. If you're carrying variable rate debt, or you're about to refinance, or you're in rate-sensitive investments, you sit closer to the blast radius. If you have low debt, a long time horizon, and a diversified mix, distant rate tremors are far less likely to knock you off course. I want to be careful here, because this is exactly where sensational channels overreach. Japan is not going to reach across the ocean and personally crash your mortgage next week. These are transmission channels, not guarantees. Whether they touch your wallet depends on how persistent and large the global repricing becomes, which is exactly why guessing isn't good enough. If this pressure keeps building, what are the realistic ways this story could play out? Nobody can tell you exactly what happens next, and anyone who claims certainty is selling something. The first is the base case, and it's the most plausible. Japan keeps experiencing real but manageable stress. Yields drift higher, the yen stays choppy, and the central bank adjusts its policy gradually rather than all at once. You'd see periodic volatility and nervous headlines, but no cliff. That means occasional market turbulence, not a structural break. The signal to watch here is steady, measured policy communication and inflation that behaves roughly as expected. The second is the pressure case. Here, things move faster than policymakers can comfortably manage. Yields climb sharply, the yen becomes genuinely unstable, and global markets start repricing risk more aggressively. That could tighten financial conditions well beyond Japan, nudging borrowing costs up and putting strain on rate-sensitive assets and retirement portfolios. The early warning signs would be disorderly jumps in Japanese government bond yields and sudden sharp currency swings that don't settle down. The third is the relief case, and it deserves airtime too, because fear tends to drown it out. In this version, inflation and wage growth stabilize, the central bank communicates more clearly, and markets adjust in an orderly way. The pressure quietly cools without triggering a broader shock. If that happens, today's alarming headlines simply fade, the way financial scares eventually do. You'd recognize it through calmer yields, a steadier yen, and a shift in tone from major institutions. Here's the honest part. All three of these are conditional paths, not predictions. You can watch these variables in real time. Still, before anyone talks themselves into panic, it's only fair to give the strongest counter-arguments a real hearing. Start with that word collapse. Unlike many indebted nations, a very large share of Japan's debt has historically been held domestically by its own citizens. That matters, because domestic holders are less likely to flee overnight. On top of that, the central bank holds tools to steady conditions. Stress is real, but stress and imminent systemic failure are not the same thing, and blending them together sells fear, not understanding. Then there's Buffett's trade itself, which keeps getting misread. He didn't buy Japanese government bonds. He bought equity stakes in specific companies, businesses that earn money across the globe, not a leveraged bet on Tokyo's public finances. So using his gains as proof that Japan is either doomed or thriving misses the point entirely. We should also be honest about the limits of what we know. Those headline gains are mark to market, meaning they rise and fall with the stock price and can look very different a quarter from now. And squeezing a sprawling macro situation into one dramatic phrase almost always distorts it. What would change this analysis? Deeper, more persistent instability? A disorderly break in the yen or bond market that domestic buyers and the central bank couldn't absorb? That's possible. It just isn't the base case today. So where does that leave you? It leaves you in a far better position than the headlines assume, because you can actually watch this story unfold instead of just reacting to it. Fear thrives on vagueness. A checklist replaces it with clarity. Here's what's genuinely worth tracking. First, the Bank of Japan's policy statements, which signal how fast they're willing to let rates move. Second, Japanese inflation and wage data, because those drive the whole picture. Third, long-term Japanese government bond yields and the yen against the dollar, the clearest real-time gauges of stress. And fourth, whether any of this spills over into U.S. long-term yields, which is the channel most likely to touch your own borrowing costs. The good news is that none of this is hidden. Central bank releases, official statistics agencies, and major financial reporting publish these numbers openly. You don't need insider access, you just need to know where to look. The harder skill is telling meaningful signals from noise. One dramatic day in the market rarely means much. A trend that persists over weeks and months means far more. So when a scary headline hits, ask whether it reflects a real, sustained shift or just a single jittery session. Beyond that, the timeless principles still apply. Diversification. Not overreacting to any one sensational title, including this one. And if you're genuinely worried about how international rate shifts could affect your retirement or asset mix, that's a conversation worth having with a qualified professional. This is education and general information, not personalized financial advice. Which brings us back to where we started, and the deeper lesson hiding behind the headline. So let's answer the question we opened with. Did Buffett get rich because Japan is collapsing? No. He got rich because Japan was misunderstood. He found cheap financing, strong globally diversified businesses, and the patience to hold them while the rest of the world looked away. That's not a collapse story. It's a structure and timing story. And that's the real lesson worth carrying with you. Big shifts in rates and currencies usually matter long before the average investor ever notices. And by the time the loudest headline arrives, the smart money has often already moved. The dramatic version of a story is rarely the most useful one. The calm, structural version is. So here's my question for you. What market or country do you think everyone is dismissing right now the way they once dismissed Japan? Where might global capital be quietly repositioning before the crowd catches on? Drop your answer in the comments. If this gave you real clarity instead of just noise, subscribe, share it with someone who needs it, and I'll see you in the next one.